If I had to explain dips or corrections or crashes and collapses and recessions to somebody in 30 seconds, I would use a visual aid of somebody breathing in and then breathing out. You know, when you're breathing in, stocks are going up, everything's great, everyone's happy, but you can't do it forever. You have to breathe out. And when you breathe out, that's when things like this happen. Now, this is just AMC on its own, but just to put things into perspective a little bit. This from here, about $60 down to 54, that's a 10% drop. And that's what you would classify as a correction. It would be a slow drop from a recent peak. But as with a lot of things in the stock market, it completely depends on your own perspective. If you were to ask 10 different people what a dip was, or what a correction was, or what a crash was, you'd probably get 10 different answers. So if somebody was a day trader using a lot of money in a single stock, 2% could be a dip. But a long-term investor who's holding a stock for, it could be 50 years, they might call 10 or 20% a dip. So it completely depends on your own strategy and your own perspective. But I saw one recently, it was a picture that somebody had created that said 10% drop is what you would call a dip, 20% drop is a correction, 30% is a crash, 40% is a collapse, and 50% is a recession. So if you were trading stocks actively, you were buying them with the intention of selling them for a profit within a relatively short period of time, then something like a few percent drop could be a disaster, and something like this, 52% down, that could completely blow up your account. If you're using what's called options, you will have things like a stop loss that you can set, which basically cuts your losses. Something like that could blow up your account. But to put things into perspective, now this is purely my own strategy, but just to put it into perspective a little bit, this is my eToro account, which is mainly or entirely cryptocurrency. And my best position, which I only bought within the last couple of days, is up 6%. And until then, these ones that have no take profit, it's called, and I think this as well included, I put these in the last couple of days. And before that, this was my best position, 54% down. My worst position is 80% down. But, as I said earlier about perspective, if I had put all of my savings, say I had 10,000 to invest, threw it all into NIO, and was 80% down, I would be having a horrible time at the moment. However, I had a similar strategy to my dividend stocks in these cryptocurrencies, and I did lots of small investments spread out across lots of different cryptocurrencies. So if this goes to zero and NIO disappears, I'll lose $25. And despite the fact that my investment in NIO is 80% down, I can still sleep well at night because of one very important thing, which is you do not put money into any kind of risky investment, so stocks or cryptocurrency, just for these examples. You never put money in unless you're prepared to lose it. If you have €800 or $800 and you need 1,000 by the end of the month for something like rent or something very important, you stay away from stocks, you stay away from any sort of risky investment. The best thing you can do is put petrol into your car and go to work and earn the other 200. Because you could put your money in and it could be 80% down. Now, a lot of people would classify 50% down as a recession. So I don't know what you'd call 80% down, a disaster. But, but because I put this $25 in with the intention of leaving it in for as long as it takes to turn a profit, it doesn't matter how low it goes. If it goes to zero, it will be bad. Fair enough. But it's such a small investment that I can sleep at night. And there's so many of them. Now, I'm not too familiar with eToro, but if I can find my kind of long-term graph, yes, here we go. 12 months. So I opened this account with $232 on the 2nd of April of last year. Kind of went sideways for a while, went up a little bit, went down a little bit, and then when it dipped, very heavily dipped in May, I put in $50, and on its way back up, I put in another 72, and then dip. Now here would have been a great point to put more money in because of my own strategy. And this ties into dips, corrections, crashes, collapses. If you're a long-term investor, you just wait for it to go down and you put more in. As long as you are not going to need it. If you are prepared to see whatever you're putting in, go to zero, and it is not going to affect the quality of your life very drastically, then you can put more in. This would have been a good point to put more in, but you know, hindsight is 20/20. I recovered for quite a while, up, then had this dip here, would have been another great one, and it's kind of went sideways since then. This I think was money out, yeah. And then I put some more in, which has since crashed. And now, because I'm at the bottom of another one of these dips, I've recently put money back in again, another $55. So in eToro, it seems to keep your individual transactions separate. So I have one here that I bought yesterday or the day before for NEO because NEO was my worst position, but it keeps it separate from this one. But in Trading 212, when I add money into a stock that's down, it lowers this percentage. It doesn't keep them separate, which is very handy. But depending on your own strategy, if you're long or short term, dips, corrections, crashes, all of those mean very different things. Everybody is a genius when their portfolio is all green like this. And you'll very rarely hear people talk about this side. But because I have so many, at least half of them are in the red. But 21% down on my worst one's not too bad. These, of course, are different plays, GameStop and AMC. But overall, something like a 10, in my own opinion, I would call 10% a dip. Now, it's a long-term opinion. I'd call about 10% a dip. Between 10 and 20% would be a dip or a correction. But a correction tends to be a drop down from a recent peak, which is what I showed you on AMC, like 60 down to 54. That here would be a correction. About 30% would be a fast and unprecedented crash. But they also have things that are called flash crashes, which would be like a vertical line down. Well, not completely vertical, but you know what I mean. Very steep line down. It can happen in the space of a day. Something like 40% down would be a collapse, but a collapse and a crash, that's where you start getting into bear market territory. So for anyone who's new, a bull run is up and a bear market is down. And if I find a nice long-term dividend play, I can give you a good visual aid. I suppose it could be any of them. Yeah, we'll try Lowe's companies. So this February 16th of 2020 down to March, it dropped from $125 down to 66. About 50%. That is a crash. That's, I suppose you'd call it a crash. It can be crash, it could be a collapse, it could be a recession. However, that happened because of lockdown. So because it's an unprecedented and very quick drop, although it is a huge one, I would call it a crash because it did not lead to a continued bear market afterwards. I'll try to find a different one. Here we go. Let's say from here, £25.39 and dropped down to £22.63. So that's a bit of a dip. Recovered a bit, dropped again. This bear market here, so over months and months and months, it just kept going down and down. Might recover a little bit, down and down and down. That's when you start getting into collapse and recession territory. because it leads to kind of continued negative sentiment on the market. People don't like seeing their money continuing to drop, and they'll start selling out. So to summarize, how people classify dips, corrections, crashes, collapses, or recessions, or disasters depends on the timeline, it depends on your own investing strategy, and it depends on the percentages, but it changes depending on what kind of investor that you are. If you're a long-term investor, you don't really have to worry about it, to be honest. If you pick companies that you have faith in and that you know that will survive huge crashes or corrections or collapses, then all you'll see is discounts. However, if you're a trader, you open yourself up to a lot more risks. And if you're using options, you're opened up to even more risks. But that's all for this one. And I hope that this clarified things a little bit, because there's a huge amount of videos coming out recently about, oh, the crash is here and 98% crash incoming. And look, nobody knows. Red flags and warning signs are the best that we can do, but nobody knows. Even if you've seen The Big Short, when Michael Burry shorted the housing market, he made that decision and he had to wait 2 years for it to come to fruition. Everybody thought he had lost his mind. He was right, but he was early. And he stuck to it. But that's all for today. And I hope that this was useful.